Wondering how crypto taxes work in the US, how to report your crypto to the IRS, and how much tax you'll pay on crypto in the US? In this updated video, I'm going to show you exactly how to do your US crypto taxes from scratch. Hello, I'm Nelly from Koinly, here with an updated guide to the US crypto taxes. Since our last video, the IRS has ramped up its focus on crypto taxes, and there's been some new guidance around NFTs, staking, and more. Before we jump in, the information in this video is for educational purposes only and is not tax, financial, or legal advice. Also, the examples I mentioned might not exactly match your situation. So as always, please speak to a qualified professional if you are looking for tax advice. Okay, so to get us started, I'm just going to dive right into covering 5 key things you need to know about crypto tax. Is crypto taxed in the US? Yup, you'll either pay capital gains tax or income tax, depending on the specific transactions you've made and whether your profit is capital gain or miscellaneous income. How do you report your crypto to the IRS? You'll report your crypto as a part of your annual tax return each year. There are plenty of ways to file, including through the IRS free file, TurboTax, TaxAct, and more. How much tax do you pay on crypto? This all depends on your total annual income and the respective income tax and capital gains tax brackets you fall into. At the time of making this video, for income and short-term capital gains, you'll pay up to 37% in federal income tax and up to 20% for long-term capital gains. Just note that NFTs that are deemed as collectibles are an exception to this rule. If you made a loss on your crypto portfolio, can you claim a tax loss? Generally, you can offset losses against gains to reduce your tax bill. And if you have 0 gains, you can even offset up to $3,000 in capital losses each year against ordinary income and carry losses forward to use in the future. There are, however, exceptions to losses due to theft. And finally, can you claim a tax loss if you get scammed or lose your keys? Unfortunately, that is a no. The IRS has taken a harsh stance stating that losses due to theft or casualty losses are not deductible. Often, the best thing to do in these cases is to simply disregard these losses entirely. Although in some instances, if you can dispose of your crypto, like with a rug pull, you may then be able to claim a capital loss. Okay, so with that out of the way, let's dive in a little deeper on how the tax system works for crypto investors in the US. First up, how is crypto taxed in the US? As I said earlier, this one is pretty simple as there are generally only 2 ways that individuals can be taxed on crypto, and that is income tax and capital gains tax. I'll start with capital gains tax. This tax applies to gains on property and capital assets like stocks, investment properties, and crypto. So it's the tax that many of us are less familiar with. There are short-term, less than 1 year, and long-term, more than 1 year holding periods, which you'll need to determine the applicable capital gains tax rate for a particular crypto holding such as BTC. The short-term capital gains tax rate is the same as the federal income tax rate. While long-term capital gains tax is much lower, so you're incentivized for holding, short-term capital gains tax applies to assets held for less than 12 months. And long-term capital gains tax applies to assets held for more than 12 months. For simplicity, our guide only covers federal tax rates. You'll also need to factor in your state tax rates. So when it comes to capital gains tax, your holding period matters. If you hold your crypto for more than a year, you'll pay a much lower tax rate, generally a maximum of 20%, excluding NFTs deemed collectibles and state taxes. As well as this, if you earn under a certain amount in total annual income, you'll pay no capital gains tax at all. This figure changes each year, but currently stands at $44,626 for 2023 financial year and $47,026 for the 2024 financial year for single taxpayers. Capital gains tax kicks in when you make a gain from disposing of your crypto. In other words, when you trade, sell, or spend your crypto. To calculate your capital gain, you need to know the cost basis of your crypto. Your cost basis is generally whatever it costs you in USD to acquire your crypto plus any related purchase fees like trading fees. If you otherwise acquired your crypto, it's the fair market value of your crypto on the day you received it in USD. A capital gain or loss is the difference in value from when you acquired your crypto to when you sold or otherwise disposed of it. If you have a profit, you have a capital gain and you'll pay capital gains tax on that profit. If you have a loss from your crypto decreasing in value, then you have a capital loss and you won't pay tax. In fact, you can use that loss to your advantage, and we cover exactly how to do that in our crypto tax loss harvesting guide. That link is posted down below. We touched on this earlier, but as a part of the Tax Cuts and Jobs Act, investors can no longer claim theft or casualty losses as capital losses. Losses that occurred before 2017 may be deductible if you have enough proof, but unfortunately, for the majority of us, these losses are best written off from your tax calculations entirely. Right, the next tax we need to look at is income tax. The IRS struggles to keep up with the innovation of the crypto market and the ways to earn. But there are some instances where the IRS has guidance that's crystal clear that you'll pay income tax on crypto. This includes getting paid in crypto like a salary, mining rewards, staking rewards, airdrops of crypto, including from hard forks. There are also other activities that may be taxed as income that the IRS is yet to release guidance on, including learn and earn rewards, referral and sign up rewards and bonuses, play to earn rewards, earning interest on crypto. Unfortunately, there isn't clear guidance on these newer transaction types, so be sure to seek professional advice here. The conservative approach is to disclose these transactions in your ordinary income. DeFi has created a lot of new investment opportunities, including liquidity mining, yield farming, loaning protocols, and more. The IRS hasn't released detailed guidance on DeFi tax yet, but that doesn't mean you won't pay tax on it. You could potentially be looking at income tax and capital gains tax for DeFi transactions, depending on how your protocol works and whether your transaction is a disposal with a capital gain or income. You should speak to an experienced tax professional for advice on your investments. If any of the crypto you've received is income, then you'll pay income tax according to your individual income tax rate. These rates can change a little each year, but you can get the latest income tax rate in our guide, and I'll put that link below. I'm going to come back to some of these scenarios like staking and airdrops, but first, let's cover how to report your crypto gains and income to the IRS. It's easy enough, but time consuming. You need excellent record keeping because you need to report every taxable transaction throughout the financial year in dollars. A tool like Koinly does this all for you and produces a report that you can then use to enter your capital gains, income, and other requirements straight into your chosen tax app, or you can hand the report over to your accountant. The US financial year is the same as the calendar year, so it runs from January 1st to December 31st each year. If you are an individual lodging your tax return, you'll need to file your annual tax return by April 15th of the following year. However, this deadline is sometimes extended to the next working day if it falls on a national holiday or weekends. Okay, so let's look at how you'd go about calculating your crypto taxes with Koinly. Okay, so to get started, you're going to sign up for a free account and then select your base country, USA, and currency, USD. Now let's look at some important settings that you'll need to select, starting with your cost basis method. Koinly supports FIFO, HIFO, and LIFO, all of which are allowed by the IRS. You can switch between these cost basis methods to see which results in the best tax outcome for you. If you've selected your home country as the United States, Koinly will automatically select the correct tax year and time zone for you. Koinly will also automatically select the following calculation settings for you. The default settings for US Koinly users are for investors. You have the option to toggle these settings to treat your profits differently, but if you're doing this, then you should follow specific advice from your accountant. Right, so with our settings out of the way, it's time to connect Koinly to your wallets and exchanges so that Koinly can import all of your transaction history. Koinly integrates with all the top exchanges and platforms either via API, or you can upload a CSV file of your transaction history. If you've traded on other exchanges and wallets, you're going to repeat this simple process and connect them all. Luckily, Koinly integrates with over 750 platforms, and if you ever need a hand, we upload new integration demo videos weekly. So now, with all your transactions imported into Koinly, Koinly is able to view all your crypto transactions to accurately calculate your capital gains, losses, and income from crypto, including from DeFi, airdrops, mining, etc. Over on the Koinly reports page, you can now see how your year stacks up with a free summary showing your crypto totals for the year. The summary is awesome, but to officially file your taxes, you're going to need a lot more detail. The IRS in particular expects you to report every disposal of crypto, including the cost basis, dates of transactions, and resulting gain or loss. So now the best part, Koinly produces a stack of cryptocurrency tax reports that cover your year's activity in great detail with calculations and totals that line up with how the IRS wants it. We support over 1 million investors around the world with reports like the IRS Schedule D and Form 8949, plus a report for TurboTax, TaxAct, and a complete tax report for just about everyone else. Simply buy a plan from Koinly and download your report. You can file your reports yourself, or if you work with an accountant, you can share it. Or you even invite them directly to your account on Koinly. Oh, and if you're filing via Koinly's TurboTax or TaxAct integration, I've actually got videos on those too, so be sure to check those out. Lastly, check your country's rules and regulations because this report might be deductible. Okay, that's the reporting process there. And as you can see, it's pretty straightforward with a tool like Koinly. Now let's dive into some transactions and specific tax implications in more depth. If your strategy is to simply buy and hold your crypto, then you generally don't need to pay tax on the transaction since you're not realizing a gain or loss. You hold even if the value of your portfolio increases. Whether you're buying crypto with crypto or selling crypto for crypto, it all works out the same from a tax perspective. In the eyes of the IRS, you're making a disposal of an asset and therefore tax is due on any capital gain as a result of the transaction. Selling crypto for fiat currency like dollars is a taxable event. If you have a gain, you'll pay capital gains tax either at your full income tax rate for short-term gains or at a lower rate of up to 20% for long-term gains, excluding long-term gains from collectible NFTs. Moving crypto between different wallets that you own is not a taxable event, but transfer fees paid in crypto may be a disposal, since the exchange may sell a portion of your crypto to pay the fees. There are a few ways to treat these, and we've got a dedicated guide, which I'll link in the description. It's also important you keep track of these movements to track the cost basis of your crypto, which Koinly can help you with. Now, regarding liquidity transactions, the IRS hasn't released any official guidance yet, but if you're adding or removing liquidity from various DeFi protocols, this could be a disposal and therefore a capital gain or loss must be calculated. Earning yield, however, is likely to be ordinary income and taxed at your marginal income tax rates. As there's no official guidance, it's a good idea to get a crypto accountant to help you out with DeFi transactions. You can find the link of Koinly's crypto accountant directory in the description below. On to airdrops. The IRS is clear that airdrops, including airdrops as a result of a hard fork, are taxable. You'll pay income tax on receipt based on the fair market value in USD on the day you receive your coins or tokens, and that's not all. If you later dispose of your airdrop tokens by selling, swapping, or spending them, you'll pay capital gains tax on any gain as a result. What about when a coin or token changes blockchains? For example, when EOS left the Ethereum blockchain for the EOS mainnet. In these situations, there are no tax liabilities. You can tag these transactions with the swap label in Koinly. It's good news for those feeling generous because gifting crypto is tax-free. Each taxpayer can gift up to $17,000 per person tax-free. Even over this limit, you won't pay tax if you're under the lifetime gift allowance of $12.92 million, but you might need to fill in additional forms in your tax return. If someone gives you crypto as a gift, consider yourself lucky for two reasons. You've just scored some crypto and you don't pay any tax when it's received. But you will need to keep record of the fair market value of the crypto on the day you received it, as this will become your cost basis if you later dispose of your crypto. Now onto crypto donations, and tax-wise, these work the same as regular donations. They're tax deductible if you're donating to a registered charitable organization with a 5013 status. You can claim the donated amount calculated as the dollar price of the crypto at the time it's donated as a deduction on your tax return. But if you're donating more than $500, you'll need to fill out Form A2A3 when filing your crypto taxes. As well as this, the IRS is clear that if you're donating more than $5,000 in crypto, you'll need a qualified appraisal. So what about crypto mining? Well, the IRS is clear that mining rewards are considered income. So you'll pay income tax upon receipt of mining rewards based on the fair market value in USD. You'll also pay capital gains tax on any gain if you later dispose of mining rewards. Regarding staking, the IRS finally clarified their position on staking rewards, stating their taxable income when received. If you later sell or dispose of staking rewards, you still need to pay a capital gains tax on any gain, just like you would if you disposed of any other crypto. Use the fair market value you calculated when you received your crypto as your cost basis to calculate your gains and losses. Profits from crypto margin trading, derivatives, and CFDs are complicated. We've got a dedicated section in our US crypto tax article that I'll link in the description. In instances of liquidation, this is also considered a disposal from a capital gains tax perspective. On to NFTs. Creating and selling NFTs could constitute a business and therefore may be taxable income. Investors creating and selling NFTs should speak to an accountant for bespoke advice on their situation. You'll use the fair market value in USD of your NFT on the day you sold it to calculate the amount you'll pay income tax on. Generally speaking, NFTs are treated the same as crypto when it comes to taxes. That means when you're selling and trading NFTs, any gain would be subject to capital gains tax. Even buying NFTs, as you usually buy with crypto, is likely to result in a taxable transaction, as you're trading one crypto asset for another. While NFT tax treatment is generally the same as crypto, there is an exception to this rule, and that's NFTs deemed collectibles. The IRS is clear that where an NFT represents an underlying asset that's considered a collectible for tax purposes, long-term gains from these NFTs will be taxed at a higher 28% tax rate. Collectibles may include works of art, rugs or antiques, precious metals and gems, and stamps or coins. Okay, if you're getting rewarded for signing up or referring users to a service like Kraken or NiceHash referral programs, and that reward comes in the form of crypto, then any crypto you get in return is taxed as income. Whether you're freelancing or working for a company that pays employees in crypto, any coins received as income are taxed at market value at the time you receive them. You may also need to file and report your crypto differently if you're self-employed. Spending crypto is a disposal from a tax perspective, and any capital gain is taxable. You'll use the fair market value of your crypto on the day you spent it in USD as your sale price. And that just about covers it. As you can see, crypto tax is by no means straightforward, but once you understand the basics of capital gains tax and income tax, the rules become a lot clearer. So I hope this guide will be helpful to you. As always, I will leave a bunch of resources below if you need further assistance with our product. If you found this video helpful, drop a like, and if you have any questions, you can leave them in the comments below or in our forum where other users and Koinly support team will jump in.